Good afternoon, dear traders. At the last webinar, I already touched on the topic of correlations. We started with practical examples, so as not to create the illusion that correlations play an unconditional role. It all depends on each specific situation, and vice versa. There are cases that uncorrelatedness can serve as a very good hint for making a reasonable decision. But what to look at these correlations, as they need to be known. And therefore today we will go through the main points. First of all, stock indexes as a guide in the business cycle, reflecting the state of economy, and even more, reflecting expectations. In this regard, in the first place, we highlight the S&P 500 as a guide. So look at my screen, please. So we have determined the key prices. Look where the relatively fresh reaction was. 3,233, 3,549, 3,674, and 3,864. I will mark for you. Okay. Now you see fresh reaction. We are interested in fresh reaction. Here selling pressure. It was earlier. Yeah. Here buying pressure. Key point. Retest. And you see from this point once again retesting. Here and consolidation. Here, selling pressure. Next picture. Now, we clarified locally, because if we intend to carry out short-term trading, then it is the local reaction that is interesting to us. So we see an exit from the range 3,900, 3,935. That is active sales from 3,935. Then from 3,901. Further, 3,822. And now there is struggle for 3,755. Why? Because here another key point. And at this, the trader falls into confusion, cannot make a decision to buy here or sell. It is scary to buy. And yesterday the price was actively falling. And selling is also not entirely comfortable. The S&P 500 stopped after the fall. When you cannot read the chart yet, it means only one thing, that the reasons for trading are not ripe either. And when can they ripen? Switch to the 15-minute charts, you see it. Here we see two key prices. The stop points at 3,723 here, and the resistance at 3,779 here. In such cases, either act above 3,779 or wait for the retest of the lower border. But then you must take into account the possible pressure in the event of a fall to 3,723 and do not rush. So, here to scenario if you plan to buy or instrument will be closed below, or it will go to retest this level, but you must wait until consolidation, until you will see that selling pressure is weak. Now, next picture. And now correlations come to the rescue to make a decision. The VIX itself, volatility index, we see that while the markets are in turbulent zone, for steady growth, the index should fall to the 10th, 11th area, as it was during 2019, 2018, 2019. You see this long period, and now this is area of turbulence. I must say right away that the VIX itself is not a tradable instrument, but the VXX ETF is already presented on the market as a trading instrument, but it contains contango. That is, it losses, unlike the VIX, about 6% per month. But what this tool is good for is good correlation clue for intraday trading in the S&P 500. In our case, we can single out 14.5. See here reaction. Then 16.28. And region from 17. Yesterday I made a deal on S&P 500 when VIX retesting 17 here. There was a reaction for all these prices. That is, now dropping below 16.28, the market turns into a bullish state and good buy scenarios may appear on the S&P 500. Moving towards 17 will call for caution in making buying decision. So here, bullish scenarios. If it will go to 17, we must wait until it will retest 17. Let's go further on correlations. As a reflection of the business cycle and the development of expected inflation, oil may be. At the moment, we see the first correlation. This is an increase in bond yields. If you look globally, then this dynamic does not cause any surprise after the average inflation over the past decades of 3%, and the yield was in the region of its 3%. So the market seems to be playing out this scenario of the 3% rate in advance. So here you see long-term 3%. Federal Reserve System's stimulus program with 0.25 rate break this yield too low, and now market playing these expectations. At the same time, the bonds themselves with the rate of return have just an inverse correlation. That is, the growth in yield is complete equality of the fall in the value of bonds. This is logical, the price of risk. This is, by the way, to the recommendations of the classics on the structure of portfolios, which contain most of the bonds. Timing, cost, and risk are of paramount importance. And also you can see here very interesting moment, technical moment. With breaking this level. And it was readable fundamentally and technically. So, the growth in bond yields reflects inflation expectations and the corresponding Fed actions. Of course, this will not happen today or tomorrow, but expectations are already played out in advance. In general, market movements is not news trading, but expectations of the subsequent development of dynamics in the future. Accordingly, the growth in profitability along with the development of the business cycle created all the conditions for the growth of oil prices. Technically, according to WTI, we also see consolidation before the continuation of the trend at 35. Let's take a look. Here, and false breakdown. That we analyzed such situation in previous webinars. And range, this range. Breaking the range, new consolidation, and trend. As a reflection of the business cycle, we can look at the ISM manufacturing PMI, reflecting future GDP futures. This indicator is leading, while the GDP indicator is lagging. We see that since the 18th, Area 60 has served at the end of the next local business cycle. Hence the turbulence in the market, but the market is still hoping for additional incentives, since the unemployment rate above 6% does not suit the US authorities. So you visually see these business cycles. And the moments of crisis, 2000, 2008, and pandemic crisis. Over the past 5 years, a clear mark at 60 has also been visible. We will definitely talk about fundamental analysis at next webinars, namely what to pay attention to, where to look in dynamics, and where to watch the price reaction. This key price of 60. Another correlation is gold to inflation and the business cycle. When inflation is expected to accelerate, this is the first asset to start growing. Take a look at the graph. Until now, inflation has not manifested itself in the reporting features, and gold has already made an increase from 1042. This consolidation and growing as expectation, inflation will rise. Before crisis, before inflation, only expectations. Now it is the turn for bond yields, but the gold is starting to roll back. There are reasons for this. These foundations works in time and often plan out expectations and not the output of the numbers themselves. And another reason, the unrestrained growth also has its cycles and key prices, and gold just approached the key price for 1911. This historical price, at which it happened reaction. That is, the still growing business cycle, the still low values of the actual inflation statistics, and the strong historical level made the scenario of a pullback possible. As for the inflation figures, they are reflected in the CPI statistics, and we will also talk about this in the fundamental analysis section. So, today we have analyzed the main correlations around. So, to speak portfolio components and the main ones, these are stock indices, volatility index, bonds, gold, and oil or commodities. At the next webinar, we will continue the topic of correlations with currency instruments, and then we will move on to fundamental analysis. Thank you for your attention. I hope this video was useful for you, and see you soon.